Hello everyone and welcome to the webinar on the City of Toronto 2024 Audit Guidelines by Lee CPA. I am Anil Achutani and I'm a financial auditor here at the firm. I also have my colleague Tiffany Wong, who is also a financial auditor. We made this webinar just to summarize the main guidelines of the recently released City of Toronto Audit Guidelines. This is just an additional resource to be used in concurrence with the funding guidelines and not an independent guideline, and it doesn't replace the old guidelines. As per this guidelines, the submission deadline for the audited financial statements or the reviewed financial statements is 4 months from the fiscal year end. They also gave an audit or review requirement for various centers. Centers which receive CWELCC and Early Ontario and Family Centers and Indigenous-led Child and Family Programs grants have to submit audited financial statements irrespective of the amount of grant they receive. But in case of fee subsidy, general operating funding, and agency operating funding, whether they are single or in combination, if they receive $30,000 per annum or more, in that case, an audited financial statement needs to be submitted. In case of these 5 grants, which are Provincial Wage Enhancement, 1999 to 2005 Pay Equity, Minor Capital or Health and Safety, Summer Day Funding, Every Child Belongs Funding, whether they are single or combination, if they receive $20,000 per annum or more, in that case, audited financial statement need to be submitted. There is only one case where a review engagement is allowed. That is, if the agencies that receive only provincial wage enhancement and home childcare enhancement grant, and the amount is $20,000 or more, then a review engagement can be done and reviewed financial statements can be submitted to the city. When a location is part of a larger agency, the threshold is to be calculated at the agency level. Financial statements also need to be prepared at agency level and not at the individual location level. But in the consolidated financial statements, different columns can be shown for different locations. In case of termination of the funding agreement, including mergers and amalgamations, change in ownership, etc., the center needs to submit audited financial statements or reviewed financial statements from the start of the fiscal year till the date of termination. How do we present CWELCC in the financial statements? The description is given over here. The whole disclosure is to be done like this. 3 columns for 3 different types of grants: the affordability, workforce, and implementation or cost escalation grant. Deferred from previous year, received in this fiscal year, used in this fiscal year according to the guidelines, and vacancy or variable cost or recovery, which we will be talking about more in the later part of this webinar. So the deferred is to be calculated by adding A and B and subtracting C and D from it. All funding types must be reported separately. Professional learning strategy funding should be reported in separate line items in the financial statements or notes. Expenses in the audited financial statements should be presented in the same categories as those reported in the budget submission. So we'll have to be careful and check whether the categories that were given in the budget are same as what is being reported in the audited financial statements as well. Variable costs need to be classified into program-related cost and food and catering for the calculation of vacancy variable cost or recovery. We'll understand why this is needed later on during this webinar when we'll calculate the variable costs. If the agencies have multiple locations or programs, the revenue and expenses need to be presented by location. If the agency has funding from more than one region, including City of Toronto, we need to ensure that the funding from Toronto has been accurately been presented according to these guidelines. If note disclosure is not given for PWE, HCCEG, and 1999 to 2005 pay equity, then a special consideration report is to be submitted showing the funding received, utilized, and the deferred funding. The disclosure for the above grants is as follows. It is similar to CWELCC except for the variable cost recovery. Deferred from prior years received in this fiscal year, expensed in this fiscal year according to guidelines, pay equity or PWE return to the children's services in this fiscal year. So we have to add the deferred from prior year and received in this fiscal year and deduct the utilized and paid amounts to arrive at the deferred to future years amount. In case this disclosure has not been given in the financial statements for any reason, we'll have to give the report separately signed by the same auditor. Staffing costs are to be bifurcated and reported as salary expenses and benefit expenses. They are not to be clubbed and reported. Audited financial statements should include 4 statements: statement of financial position or balance sheet, statement of operations or income statement of change in equity or statement of change in net assets, and cash flow statement. If the audited financial statements or reviewed financial statements are not as per the format laid down in the guidelines, restatement might be required, and the cost for restatement is not reimbursed by the city. Management representation letter and the audit finding letter given by the auditors are to be submitted by the centers to the city. In the case of a qualified audit report, further review might be performed by the city, and if found inadequate, might result in sanctions or penalties and termination of the funding to the center. Audited financial statements must be signed by the operator for commercial agencies or by 2 signing officers in case of non-profit agencies. In the case of non-profit agencies, the signing parties should be the ones listed in the Schedule A of the Ontario Corporate Initial Tax Return or Notice of Change. Others are not accepted. Non-profit agencies have to submit the annual general meeting minutes every year, showing the approval of the previous minutes, previous audited financial statements, election of board of directors, and the auditor. Budget is compared to the actual expense, and this analysis will be done by the Toronto Child Services. How is the review of salary expense or TFOs performed? Minimum wage and CWEL workforce funding are checked whether they meet the legislative requirements. T4 is compared with the budgeted salary, and the reasons for any differences are noted. Total payments made to staff needs to be compared to the maximum allowable salary. Check the CWEL, PWE, and GOG guidelines, and this must be according to these guidelines. In case more is paid, reasons are to be documented. If it is more than the maximum allowable amount, recovery might be needed. Overstaffing or understaffing is checked by comparing the number of staff with the budget. Composition between casual and permanent staff is also checked. Reasonableness of central allocated administration in the budget is compared to the actual T4 for the staff. Audited financial statements versus T4 amount, and if there is any difference, the reason is documented. Over to Tim.
Thank you. Hello, everyone. So I will follow with the transactions that are not funded by the city and are not allowed to be included during the grant reconciliation. So first, it includes loans to the employee and advance to the shareholders, intercompany transfer, allocation or chargeback, drawings on equity, expenses outside the City of Toronto, which only the CWELCC provided for the licensed home childcare outside of Toronto can be used. Program or allocation that do not have a service agreement with City of Toronto. Bad debt expenses, goodwill write-off, loan interest, principal portion of loan or mortgage, personal vehicle expenses or maintenance of vehicle, insurance, and gas, head office rent, school bus expenses, including insurance, associated business enterprise, including charity of the agency, other costs not included or approved as per budget or funding application guideline, or that do not directly support the provision of service to the children and families. repayment to children's service for recoveries, transaction related to prior financial year, and the expenses over and above the threshold set in the budget or funding application guidelines, Canada Emergency Business Account, loan repayment, interest, and/or CBA loan forgiveness. It is the responsibility for the operator to provide appropriate evidence. If repayments are from source other than TCS funding and/or the loan was utilized for expenses which were not funded by TCS. Dividend paid. Only commercial agency can pay dividend, and T5 need to be submitted to the budget consultant or coordinator. And dividend paid needs to compare with the budget. Excess will be recovered. For the surplus or deficit, agency can only accumulate surplus equal to 6 months of average operating expense, and it is to calculate the fee subsidy recovery. And we can follow the Appendix 1 as an example to calculate the fee subsidy recovery. First, we will take the allowable revenue, which is A in 120,000, minus the allowable expense. The disallowed expense are removed from this amount, which is B, 90,000. And this will come up with the operating surplus, which is C, 30,000. And the operating surplus percentage is using C, 30,000 divided by A, 120,000, and comes out with 25%. For the total fee subsidy and general operating funding, we will sum up the parent portion of fee, subsidy fee, and the general operating funding, which come out with H, 109,000. For the recovery calculation, city funding percentage of the allowable revenue will use H, which is 109,000, divided by A, 120,000, and it's come out with I, 90.83%. And 10% of the allowable revenue, which is A, 120,000 times 10%, which come out with J, 12,000. And the excess operating surplus over the allowable revenue will be using C, 30,000 minus J, 12,000, and come up with 18,000. And finally, the recovery amount will be using K, 18,000 times I, 19.83%, and comes up with L, 16,350. Appendix 3 is an example showing the notes disclosure for the federal support and the non-TCS fund grants by program type. And this is the notes disclosure showing in our financial statement. So here's the guideline for calculating CWELCC recovery. So for a more detailed calculation, I will walk you through in an example. So first, in phase 1, we would calculate the eligible vacancy. The eligible operating capacity will be using the operating capacity minus the CWELCC in eligible operating capacity, which is the student age over 6 years old. And this come up with 120. And the eligible actual enrollment is to sum up all number of students aged between 0 to 6 years old, which is 94. And the eligible vacancy will be using the eligible operating capacity, 120, minus eligible actual enrollment, 94, which come out with 26 space. And in phase 2, we will calculate the eligible vacancy variable cost and recovery. So first, we will sum up the program-related cost and the food and catering cost, which come out with 150,000 actual variable cost. And then we will divide it by the operating capacity, which is 150 space, and comes out with 1,000 cost per space. And then we will use the eligible vacancy, which is 26 space, and this space comes from phase 1. And then we will come out with the total vacancy variable cost in 26,000. And lastly, the total vacancy variable costs are multiplied by the 2024 CWELCC reduction rate of 52.75% and equaling to the recovery at 13,715. Thank you. If you need any professional advice, you can reach out to us at info@leeca.ca or 905-707-0136. Thank you.